As 2022 continues to be an extremely volatile year in the stock market, we've seen the share price of nearly all dividend and income stocks fall. What's resulted is many dividend stocks offering substantially higher dividend yields than normal, which represents a great buying opportunity for high-quality dividend stocks currently trading at a discount. But some dividend stocks have fallen much more than others this year, and as a result, we're seeing some stocks now offering investors insanely high yields of over 15% or more. So in today's video, I thought it'd be a good idea to briefly look and examine every single dividend stock currently offering a 15% dividend yield or more and see if there's any great opportunities out there with any of these companies. As of the making of this video, there's currently 5 stocks that are offering investors a 15% dividend yield or higher. We're only going to be taking a look at individual stocks, so no ETFs, exchange-traded notes, and no preferred shares of any stocks. We're also not going to look at any closed-end funds, which are really similar to mutual funds, and I see people mistake them for being stocks all the time. So for example, the Cornerstone Strategic Value Fund, ticker symbol CLM, and Oxford Lane Capital, ticker symbol OXLC, won't be on this list because they're closed-end funds. As an additional rule, only stocks that have been paying dividends for at least 1 year are also going to be covered on this list. So with that being said, let's go ahead and get started. The first stock we're going to take a look at is MFA Financial, ticker symbol MFA. This company invests in residential mortgage assets, including non-agency mortgage-backed securities, or MBSs, agency MBSs, and credit risk transfer securities. This company is structured as a mortgage REIT in the United States, and it uses leverage to invest in these mortgage assets. They were founded back in 1997, which makes them one of the older MREITs in this sector, and right now their stock is offering a yield of 15.15%. Just by looking at MFA's share price performance, we can see a couple of concerning things going on here. Their stock is currently down over 36% for the year, which is far worse than average, even for MREITs in general, which just recently took a hit. If we look at the entirety of MFA's share price performance, we can see a pretty tragic story. From 1998 all the way until 2020, this is a company that was moderately successful in this sector. While there wasn't much growth for MFA, which is typical for an MREIT, it did offer a really nice dividend yield, and they did manage to survive the 2008 financial crisis, unlike some other mortgage REITs. But then in 2020, this company got absolutely crushed, and it's been continuing to struggle through hardships. I have no doubt that a lot of investors probably suffered a lot from this crash in 2020. Their dividend got eliminated during the pandemic, but they've since started paying dividends again. But they only pay a little over half of what they used to pay shareholders. In April, the company had a reverse stock split, which is something that made a lot of shareholders very unhappy. I'm assuming they did it to try to prevent their stock from falling further, but so far it hasn't worked for them. Combing through their financial statements, we can see even more troubling issues going on. Their book value has seen a downward trend for more than a decade, which isn't good if you're hoping for further dividend increases in the future. In the end, MFA Financial is a company that's not in a good spot right now. On their website, they have a letter from their CEO which describes some of the issues the company's been going through. The whole MREIT sector hasn't been faring too well for companies that only invest in mortgages. MREITs that issue their own loans or also invest in physical properties usually have better track records when compared to MREITs like Annaly Capital or AGNC Investment Corporation. This stock, in my opinion, is one that isn't worth all the risks involved, considering that there's better options out there in this sector with yields still above average. Now let's take a look at Cherry Hill Mortgage Investment Corporation, ticker symbol CHMI. Cherry Hill is a residential real estate finance company. They acquire, invest in, and manage residential mortgage assets in the United States. The company operates through investments in RMBSs, or residential mortgage-backed securities, and other servicing-related assets, including mortgage servicing rights. According to a quote on their website, their mission statement is to consistently generate attractive current yields and risk-adjusted total returns for our shareholders over the long term, primarily through dividend distributions. Right now, their stock offers a dividend yield of 15.84%. For the year 2022, CHMI stock is down about 18%, which isn't as bad as others in this sector, including MFA Financial. But going back to their original inception, we can see a similar pattern with both companies in terms of their share price performance. Both companies were performing somewhat decently while offering high dividend yields until 2020 when they were hit particularly hard. And now in 2022, we're seeing both companies struggling to recover to their original pre-pandemic levels, with things starting to take a downward trend again. If we look at Cherry Hill's dividend history, we can again see a pattern of cuts throughout their history. Since being founded in 2014, the stock has reduced their dividend about 4 times, which isn't as bad as MFA, but MFA has been around much longer than Cherry Hill. It pays a quarterly dividend, with their last being for 27 cents per share. Before the pandemic, their stock was paying 40 cents per share, which is a decrease of about 32%. Again, it's not quite as bad as MFA in terms of how drastically their performance has dropped. With Cherry Hill's financials, we can again see troubling signs on their balance sheet. Their book value was pretty stable between 2013 and 2017, but then starting in 2018, they reported a pretty sizable decline in their book value, and it's been going downhill ever since. So to summarize, there's a number of similarities between MFA and Cherry Hill in that they're both mortgage REITs that are going through pretty difficult times. However, Cherry Hill appears to be in a better position than MFA in my opinion, but I still wouldn't recommend investing in either company. If Cherry Hill keeps seeing their book value drop, then I think more dividend cuts are probably going to be inevitable at this point. The next company on this list is Armor Residential REIT, ticker symbol ARR. Armor invests in residential mortgage-backed securities, or MBSs, in the United States. The company's securities portfolio primarily consists of the United States government-sponsored entities, or GSEs, and the Government National Mortgage Administration's issued or guaranteed securities. They're backed by fixed-rate, hybrid adjustable-rate, and adjustable-rate home loans, as well as unsecured notes and bonds. Their stock offers an incredible 17.65 dividend yield as of the making of this video. If you follow my channel, you know that I've talked a lot about this stock in the past, because this is a really popular dividend stock that a lot of people who are brand new to dividend or income investing like to invest in. Let me show you one graph that perfectly shows just how this stock has performed. Since their IPO in 2007, Armor's stock has lost over 90% of its value. If we look at their dividend distribution history, we can see a long pattern of dividend cuts throughout this company's existence. In the last 10 years, this stock has cut its dividend about 12 times, which is astronomically bad. I also find what's on their website and their investor presentations to be pretty laughable. Usually companies like to put together these elaborate presentations that discuss all the reasons why everybody should invest in them and what they're anticipating in the future, whereas Armor Residential doesn't really provide a whole lot of information. These investor presentations are supposed to be brochures as to why everyone should consider investing in them, but it's pretty clear that they really don't have a lot of good things to say about themselves other than that their stock pays dividends monthly. Their financial statements unsurprisingly paint a very bleak picture. Much like their share price, their book value has fallen by more than 80% in the last 10 years. This obviously helps explain the dividend cuts this company has been going through. Their net interest income has been pretty terrible, and considering their shrinking book value, I can only assume that things are going to get worse. To summarize what we've looked at, I hope I pointed out enough reasons why you should not invest in this company. I know the dividend yield is almost unmatchable, but if they don't improve their numbers, then I think the dividend will have to get cut again soon. Up next we have Icahn Enterprises, ticker symbol IEP. This is Carl Icahn's investment company, which owns businesses in a wide range of industries including energy, automotive, food packaging, and home fashion, among others. This company is structured as a master limited partnership, which has some really important tax implications I'll discuss later in this video. But right now, IEP offers investors a dividend yield of 16.62%, and they pay dividends on a quarterly basis to shareholders. I made a video about this stock back in January in which I went into more detail about how just complex this business is. I've heard some people say that investing in IEP is almost like investing in an ETF. That's because Icahn Enterprises owns a whole lot of other businesses. You can see on this chart that Icahn owns an investment company, real estate assets, a pharmaceutical company, Icahn Automotive, which owns Pep Boys and Autos Plus, among many other corporations. This is a really unique company that's really hard to analyze simply because you'd have to comb through the financials of every single one of these companies to get a clear understanding of how they're performing. Plus, in order to do a really good job at analyzing, you'd have to know a lot about real estate, furniture, textiles, and the automotive industry, among many others, which I really doubt anyone is truly an expert in every single one of these areas. But what I think is the most important thing to keep in mind about this stock is that when you invest in IEP, you're basically investing alongside with Carl Icahn. Carl controls this company, and you kind of just have to have faith that he's making good picks. But the guy is one of the most successful investors in the world, so that does say a lot. At the same time, I think it's important to keep in mind that Carl is currently 86 years old and his son is planning on taking over the company when he passes. So I'd recommend that anyone who's interested in this stock should read up on Icahn and what exactly he looks for in an investment. Another thing to note, as I mentioned earlier, this company is structured as a master limited partnership, which will make filing your taxes a little more difficult. They send investors a K-1 tax form, which is something you don't receive with other companies. I'm not going to go into detail on these, but if you're considering investing in IEP, you absolutely must do your research on MLPs and K-1 tax forms. In terms of performance, the stock has performed significantly better than any other company we've looked at. It's had its fair share of spikes in the past, but the share price has basically flatlined over the last 6 years. But something that is a little impressive is that they've slowly been able to grow their dividend a bit over the last 5 years, although they haven't grown it since 2018. To sum this stock up, I think it's a decent pick, but because it's an MLP, I don't own it because I don't want to have to deal with the tax situation. If you're interested in this stock, you need to have faith in Carl Icahn, his replacement, and you need to be okay with it being an MLP. Finally, our last 15+ yielding stock is Orchid Island Capital, ticker symbol ORC. Orchid Island is a specialty finance company that invests in residential mortgage-backed securities, or RMBSs, in the United States. The company's RMBSs are backed by single-family residential mortgage loans referred to as agency RMBSs. Their portfolio includes traditional pass-through agency RMBSs such as mortgage pass-through certificates and collateralized mortgage obligations. Their stock offers the highest dividend yield out of any company on this list at an eye-popping 18.56%. If you watch my channel, you probably already know what I'm going to talk about. Just like ARMOR Residential, this stock follows a very similar pattern in terms of stock price performance and dividend cuts. Since their inception, Orchid Island has lost over 80% of its value. That's actually worse than ARMOR because Orchid Island has only been around since 2013 compared to ARMOR's 2007 IPO. So Orchid has crashed faster than ARMOR has. In terms of dividends, they do pay monthly just like ARMOR, but they cut their dividend all the time. They even just cut it 4 months ago for about the 5th time in 5 years. They are becoming less leveraged as time passes. You can see it's been moving downward since 2019. I guess they realized that this strategy of additional risk hasn't been paying off for them up to this point. Again, just like with ARMOR, their book value has been falling as the years go on. In fact, they've never had a year where their book value increased, which again is really important for companies like REITs and business development companies. I think both Orchid Island and ARMOR Residential are suitable contenders for some of the worst dividend stocks out there. There isn't anything I want to do with this island, and my wish is that everybody would stay away from this stock and ARMOR Residential. And that's going to wrap up our look at every 15% plus yielding dividend stock currently out there. It may come as no surprise as all of these holdings are very high risk, with some being riskier than others. My advice to everyone would be to avoid these kind of holdings unless you're okay with taking some extremely high risk here. Icahn Enterprises is probably the best stock on this list, but the fact that it's an MLP and it's a very complex company, I'd only recommend buying it if you strongly believe in Carl Icahn's investing strategy. But regardless, make sure you always perform your own research and due diligence before investing in any company. Make sure to diversify your stock portfolio across different sectors and holdings to reduce the amount of risk that you're exposed to. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.